Awesome. So we've rolled out a 5-factor risk model into the alpha theory environment in partnership with Factset. So we worked with their quantitative factor library and along with their data science team to create a 5-factor model based on the or using these 5 kind of common factors. So beta, value, growth, momentum, and volatility. So one way to just kind of orient ourselves with this is we have factors are, or you can think about beta, right, as if the market moves, market goes up, it's going to have an impact on the price of your stocks. So as your beta is, your beta increases, you're going to have more, that means it's going to move more with the market. Same thing with these other factors. We're just creating and generating using different metrics, other ways to explain why and how prices move in your portfolio. So trying to explain the cause of price movements in the portfolio so that as you can try to account for those and strip them out, you can get a better sense of the true kind of idiosyncratic alpha of the stocks that you're picking. So that's really all we're trying to do here with factors. And so what, just to kind of set a level set here, the kind of the relationship of a ticker to the factor is expressed in a z-score, and that's simply just stating how many standard deviations is this asset away from the mean of, say, the entire universe of securities that you're using to calculate what this kind of factor is. So how far away from the mean of all the other tickers in the universe is this individual ticker that we're looking at? That is what's going to drive how we get attribution and exposure to each individual ticker in the app that you'll see. How we calculate those kind of components that are used to determine the final z-score of the factor. For beta, we're using kind of long-term beta, down market and up market beta. We're using a number of fields, and all of these are equal weighted to generate the value factor. And I'll send this PowerPoint out to everyone after this call, so we don't have to go through all these kind of bulky slides. But this is just to give you a sense of what goes into calculating each of the factors and determining how certain names are exposed or related to each of the factors. So momentum and volatility. So I'm going to dive into the app here, and what I want, what the main takeaway for how to use this within the alpha theory framework is going to be, using it as another tool, as another layer, another piece of the decision puzzle, so that you can say, we're building an optimal position size based on fundamental bottoms-up research. This gives you another tool to look at, okay, if I were to make this trade, how does this impact me from a factor perspective? And so let's dive in to that. So you'll recognize, the alpha theory screen. And here we're looking at a Factset risk attribution view. So this is daily attribution. So this is looking at how factors impacted our portfolio yesterday. And we can see if you go all the way down to the bottom line, beta had somewhat of a positive impact, negligible impact from growth, somewhat negative impact from value. Volatility negatively impacted us, but the biggest driver of portfolio performance yesterday was momentum. So it had essentially a negative 12% impact on our portfolio price return. So what we want to do with that is say, okay, how can I make trades based on my fundamental bottoms up research that will also help me, maybe I want to be less exposed to the momentum factor because, it was the largest mover in my portfolio yesterday. So you can flip over to the exposure view. And from here, now we're flipping from attribution to how am I currently exposed to these various market factors, right? So we can go over to momentum. You can say, well, I have a 12% exposure to the momentum factor, and I would like to lower that. So what you can do is look at these columns that are percent from optimal exposure, and we can sort it, and you can say, okay, so this trade, so selling out of CCJ is going to have the biggest, is going to be aligned with one of my large trades from a fundamental perspective. So my fundamental research is telling me to get out of this name. This is also going to be a big benefit to me if I want to lower my momentum exposure. It also can work, almost in the somewhat opposite way. So I can add to this name, but because it has negative exposure to, or has a negative relationship to the momentum factor, by adding to this name, so again, making an addition to this name based on my fundamental research, I can also lower my exposure to the momentum factor. And you can do this for all 5 of these, right? So say, volatility we saw also was a bit of a mover, and say you wanted to lower your exposure to volatility. And we can see again, Shopify. This is something that is going to align well with my fundamental research. It's a large suggested trade. It's also going to help out if I want to lower my exposure to volatility. Perhaps I want to increase my exposure to something. So say I want to have more exposure to growth. So, I can, this is, this name, I'm getting a 7.5% from optimal suggested position increase from my fundamental bottoms up research. This is also going to increase my exposure to the growth factor. And so if I believe, if you have an outlook that says, hey, I think this factor is going to be a net positive in the market, I want to be more exposed to it. Or we're currently short this based on our current investing strategy. I want to be more growth neutral. You can just quickly see, okay, if I were to make trades based on our fundamental bottoms up research, how is that going to impact me from a factor perspective? One of the key ways we've seen folks use this, and that we envision using this, is if you're comparing between 2 trades that are relatively the same magnitude. So say Unilever and Goldman Sachs, they're both roughly 6% add suggestions. If one of them has, say you want to, again, increase your exposure to growth, you would, if you were deciding between, you could only do one of these trades, you would say, oh, I can go with the Goldman Sachs edition because it's going to do more for me from a factor perspective, at least in terms of what I'm aiming for. And so that's really how you can leverage these factors. And we have these 2 views built out, but you can work with myself and my team to, add these columns into existing views so that you can, embed them into your current kind of, whatever your decision-making workflow looks like, or you can, navigate to them yourselves. And we can obviously, talk about further, ways to incorporate these into your existing workflow and model. But really, what we think the biggest kind of key for this first iteration of the Factset risk offering is going to be, helping me determine, with all of the trades that are being suggested by my fundamental bottoms up research, which ones are going to help me the most, or which ones are going to satisfy my desires from a factor perspective. And so that is, again, for V1 of this. And, we want to kind of continue to use this and continue to build out more, and expand the offering. But I'm interested, I'm interested to know if anyone has any questions or any kind of comments or things that they want to maybe explore further.
Hi, John. Thanks for the presentation. So just trying to understand, over what time period is what data over what time period do you use to calculate the Z-score?
So this is using, this is a daily calculation. So one of the things we're looking to expand to is using getting a larger time horizon, so a year-to-date or month-to-date calculation time horizon. But right now it is recalculated each day.
He's asking about the Z-score, which is 1 year. So some of them are different, but we're all like, if we're looking at a growth rate, it's going to be 1 year. If we're looking at a book value, value, it's going to be contemporaneous. It's going to be the current day.
Sorry. Thank you, Cam. Yep. Does that answer your question?
Yeah, because I was just thinking, if you're suggesting, if someone wants to get exposure to value and you buy something, but that score in itself is shifting, you buy thinking it's a value or addition to value in the portfolio, but by the time you make the trade order, like if the score changes in the next month, then it's not of any use. Like if I'm buying with a 1 year or maybe not even 1 year, I'm buying with a 3-year horizon. So if you're saying by adding to Goldman Sachs, I'm adding to growth in my portfolio, that should be that growth till for Goldman should be true for the next 3, or am I expecting it to be true for a longer period than 6 months or 2 months, because I'm going to hold it for a while?
Yeah, what you have in the app today is essentially, somewhat backwards looking. It's not a predictive risk module. So it's giving you a sense of, essentially how has this been kind of impacted by these factors historically, and using that to extrapolate out further. So yes, I think I think it's still telling, and I think it's still a valuable insight or input to your decision-making process. But yeah, it's no guarantee that in 2 years from now it will still have a positive exposure to the growth factor.
And that is also one of the things that you can do when you see the Z-score for Goldman being, let's just say that it's value, and you see a 2 as a Z-score, you may say to yourself, yeah, that's what Goldman used to be. I don't believe that. And so I'm not going to make the trade because I'm going to put my fundamental overlay of what the future is going to hold.
Yep.
My other somewhat related question is, typically portfolios that are run based on a quant model, the biggest use of factor-based trading or suggestions to trade is in identifying what is being rewarded in the marketplace, which to some extent, I think you had that by saying that, but that's a very short period. Like, I want to know, and maybe to some extent being forward-looking, to say that even if it's of a relatively short period, next 3 months, the market is trending in a direction where growth is being rewarded. So I should maybe gain more exposure to growth. Is there some way for me to figure out kind of what is being rewarded in the marketplace with somewhat of a future tilt, even if it's based on the last maybe last 2 weeks data, but something that addresses where the market might be going in the future?
Yeah, were you gonna say something, Cam? Sorry.
Yeah, do you want me to take that, or?
Sure, go ahead.
Yeah. So the answer is yes, it will show you a return for by factor. So you'll be able to see what the returns of the factor have been. You would have to have your own forecast of where it's going to go. That's not something that the system is designed to do. Here's the larger concept, is that through our analysis at Alpha Theory, we have determined that the skill set that managers have, at least for Alpha Theory clients, is they're good at picking stocks and they're good at picking industries. What we don't find in the data is they have any demonstrated skill in timing markets or in picking style factors, which these are. So the idea here is not to play a factor that you have some expectation is going to outperform. If that's something that you want to do, that's kind of a different approach, and the data is here to do that. But I think that what we were trying to do is to allow people to find the outsized exposures from a factor perspective in their portfolios that they may not have known were there, and are not getting, they're generally not generating positive returns from, and to help them neutralize overexposures, because those things can end up whipping around a portfolio, and the whipping around of the portfolio can end up having deleterious effects with our LPs, and it can also make us reactive in a way that is counterproductive.
Okay, understood. So just on that, we are clearly in a growth-oriented environment, or we have been in the last year to date. So what is the one number that I need to check on to say that would reflect the fact that we have been in a growth environment? Like you said, you could check that somewhere here.
Well, I think that, what is the time frame for the returns for?
It's
Even let's say
daily.
year to date.
Yeah, so right now it's just daily returns. Oh, sorry. So we're working on, Aman, like the next phase would be to include year to date and trailing 12-month return attribution. I think to Cam's point, this first version, the goal is to more so focus on exposures and give you a sense of, like you said, where are there potential risks in your kind of portfolio construction that you might not have been aware of. This is not, particularly in this version, this is, and Alpha Theory is a fundamental optimization tool. It is not a necessarily optimizing for these factors. It is trying to give fundamental managers an idea of where there might be unintended risks that they're taking, and particularly in this V1. Now, I think what you're kind of getting at is where we want to move into the future, particularly from an attribution perspective. So how have these factors been moving over longer periods of time, year to date, trailing 12 months, 2 year, 3 year, things like that, even month to date, just trying to give more, color around how those factors are moving. But I think in this first version, we're really focused on, we really wanted to get this out so that people could start understanding the exposures and how they might be impacting their portfolios in ways that they weren't necessarily intending them to.
But even on a one-day basis, so where do I see when it says where it says optimal exposure beta and you have 6.1? Is that telling me that for the last trading day beta should have, like, what does that 6.1 score, like, is it somewhere telling me that yesterday's trading was good for momentum and not good for value?
So that would be the first view we looked at. So this attribution view. So you can see the return of the actual factor as constructed by as constructed through in partnership with the Factset team, how that factor is and then applying the z-score to the factor to get that ticker attribution, and then applying your own exposure to get the kind of factor contribution to your fund for the previous day. Does that make sense?
Yeah. It'll be clearly more useful if it was over a longer period, but I get what you're
Yep.
trying to do. Thank you.
Oh, sorry, I want to keep doing that.
You'll see those. This is V1.
Yeah.
And this is a great thing about getting, once you put it out there, you put it out as a minimum viable product, and then you get feedback. And so that's great feedback.
And yeah, I mean, you're asking the right questions, Aman. I mean, it's the same thing with any sort of analysis. The longer time period, the more data you have, the more statistically significant it's going to be. So yeah, that is on the roadmap.
But the z-scores are over a long period of time, so they are statistically significant. Those are the ways that factor models are built, and we're using best practice from Factset in building these z-scores and exposures. It's just the performance piece just will add more time.
Yep, that's right.
Hi, John and Cam. This is Sharon. I just have a quick question on this. The example we just gave, this portfolio. It seems like the exposure to momentum is the biggest factor, negative factor today, right? So if was this true for yesterday? Like how much do they change on a daily basis? Could it be today it was this factor exposure to the momentum, but yesterday was actually the factor to exposure to the growth factor?
Right. Yeah.
And how do we? If I even if I
how
didn't
volatile,
make any change,
how volatile is that?
Yeah, and even if I don't make any change to the portfolio, the exposure could change every day. And how do you justify that? Like,
let's start with answering the first question.
Okay.
Did you want to take
Go
that,
ahead.
Cam?
Go ahead, John.
So sorry, what was?
It is that it's not going to change that much from day to day. So if you change your portfolio position sizes and the constituents in the portfolio, yeah, of course it's going to change. But if you have the same positions with the same share counts from one day to the next, it's not going to really change that much. So it's going to be fairly static. You can imagine the
exposures will be. Sorry, was it?
Just
right.
Yeah. The exposures are going to be fairly static. So John, can you just go back to the things that, no, go back to the PowerPoint. And then go up to, let's go up one more, because that's a little, let's go back up one more. Let's go to like value. Perfect. Dividend yield, how often does that change? Earnings yield, how often does that change? Operating cash flow yield, a lot of these things, the numerator, which is they change quarterly. Of course, the denominator, the price, is going to change daily, but it's not going to change so rapidly that it's going to put it into one. It's going to dramatically change its z-score unless there's a big move in the stock price. And then if there's a big move in the stock price, then there's actually probably should be a big change in the z-score associated with it. So you can imagine based on that, how frequently the exposures of your portfolio are going to move. They're not going to move that much if you're not changing the positions and the share counts.
I think I can understand how growth and value are probably not going to change that much, and even beta probably are not. But the momentum factor there, that could. And
volatility, both of those are. Volatility is a volatile factor.
Is more volatile. Yeah.
So is momentum, but they're still not going to change. You're not going to go from being positive 10 to negative 10 over the course of a day. It will happen over time, but Yeah,
It could be today is the momentum factor that gave me the biggest attribution, right? It's the minus 12%. And tomorrow, and maybe momentum is negative 12% and volatility is negative 10, and tomorrow it will switch. And then if I'm trying to use these factors to adjust my portfolio, then today I use momentum as the biggest factor. I'm trying to reduce like my exposure to momentum, but then tomorrow when I look at this again, I have to adjust it to volatility. Like
you don't necessarily. I wouldn't think of it that way, because if you have one's 10 and one's 12, I mean, in your mind, you'll know that they're both pretty important.
I also want to.
You may say you're overexposed for both. It's not just picking one or the other, just picking the biggest one and minimizing it. It is picking the ones that are overexposed and minimizing those.
Yeah, I think that we're getting. So I think there's a difference between the attribution and the exposure. So it could be that momentum was the biggest factor mover in terms of like how it impacted the portfolio one day, and it could be volatility the next. But from an exposure perspective, the exposures won't necessarily change. So I think that what you're trying to do is manage, how much exposure to these, volatile factors and volatile factor moves do you want to have? So the attribution daily can change. That is, and I think, Chen, that's what you're kind of describing is, if momentum moved one day really against you, it doesn't necessarily mean that you have to that day, then try to lower momentum so that you don't have it move against you again. It's just a way to highlight, hey, it moved against us pretty heavily and we're really exposed to it. Is this a risk that we feel comfortable continuing to take? I think that's the way to use this, is not necessarily as reactive as, oh, this moved against us, let's trade. Is this a risk that we're willing to continue to take?
That makes sense. So if you go back to that exposure
Sure.
slide, so those optimal exposures, those are going to change too, right? Like every day, or
only slightly. I mean, it'll change as either your research changes, or the price changes, right? So as the optimal position size changes, those will change,
okay.
Slightly. But again, the Z scores are going to remain, because at least for some of these longer term components, so like earnings yield and things, those Z scores aren't necessarily going to vacillate like crazy. So if you have an optimal position size, say you update your research after an earnings call and the optimal position size goes from 12 to 5. Yeah, the optimal position sizes at the factor level will probably change some significant amount, but it will change because the optimal position has changed a significant amount.
Okay.
Not necessarily because the Z scores changed.
All right. Thank you.
Does that help give some more clarity there? Make sure we answered your questions.
Yes, but I
Great.
still like when I look at this, because I think from your presentation, I feel at first we should look at the attribution slide and identify like which factor we has the biggest attribution, and then we come back to this exposure view and trying to see, what's optimal exposure and how does that relate to the optimal position and the trading strategy, right? Because there's so many numbers on this slide, and this doesn't really give us a starting point. So the attribution still make.
Yeah,
we should start with the attribution and then come back here and see, right? Is that the right way to use this? Or?
I mean, I think the attribution should be used simply as a call
explainer
out
of what has happened.
Yep, and a call out to say, okay, so this has happened. This happened yesterday. let's go check our exposures. Are we still comfortable with, with these exposures? Not like I said, it's not necessarily we lost, this factor moved against us. We need to go immediately and trade and try to lower our exposure to
No.
that factor. But it's just a call, like I said, it's a kind of call to action, like, hey, this is saying, yesterday these factors moved against us or these factors moved for us. These are the risks that we might be taking currently in the portfolio. Are we comfortable with these risks? And if not, what trades can we make to help minimize them?
Yes, understood. I'm not saying we're going to trade just according to this. I'm just saying how can we best use this tool? Like, what does this give us?
I'd say you don't start with attribution, because attribution is going to be a short period of time. It's going to be retrospective. This is to look at the exposures, which is the first column of each one. So you could point to the exposures. There's exposure of beta, there's exposure of growth, there's exposure of momentum.
Oh, sorry.
That is the portfolio's exposure to these factors. And if you see at the bottom, it's 2.7% is beta. It's going to be, you may be okay with that. The growth exposure is also small. The momentum exposure is fairly large. And if you go over to volatility, it's also really large. It's 23. And so you say, are we okay? We're basically in a situation like that. You're making a bet on, you're making a long bet on momentum stocks and a short bet on volatility. And you have to say to yourself, are we okay with that? And if the answer is no, then it's showing you how to trade those to reduce that exposure where it lines up with your research. It's always research first, where research is telling you to make a trade, and then it also does the thing that you want to do to reduce your portfolio exposure.
Hey, Cameron, this is Derek.
Hey, Derek.
How are you?
Good, man.
So I actually have a question about what you just described.
Mm-hmm.
Is there any way to like normalize or size that? I mean, you weren't putting much, you weren't really like, you're sort of like, we have a lot of exposure to these factors. Like,
Mm-hmm.
Can you normalize it for the volatility of the factor?
Yeah. So point being is that momentum and volatility are more volatile factors than growth and value. And so
Correct.
having a bigger exposure to a more volatile factor is a bigger deal.
Yes.
Yeah. So I'm sure there are. Let's understand that we are, this is risk 101.
Right, but I guess, I mean, it does bring up the question, because it's like, I mean, I've used this as the exposure. The attribution one, like for all the issues we discussed, is like a little tougher to get much information out of. But like thinking prospectively, like of what, I mean, I think the goal is to think about what type of volatility risk you are taking in your portfolio, and without knowing what the volatility of the underlying factors are, it's really hard to normalize and determine what
what you're comfortable with.
Yeah.
What level of exposure you're comfortable with.
I see, in mine, it's like, oh, you're overweight momentum or you're overweight, whatever. But I don't know what that means. Like if there's a 1 standard deviation move in momentum, what does that mean for me?
Mm-hmm.
Right. And then I can think about, okay, well, maybe I'm comfortable with the 2 standard deviation, whatever it is, right? And that's how you would want to manage risk, I think. But
yeah,
it's harder to, I mean, you can kind of do it with these tools plus like some other tools in Bloomberg, I mean, obviously there's more sophisticated stuff, but you can piece it together with kind of the basics. But that I think maybe would be helpful in thinking about.
That's a good, that's an interesting, so we would take the exposures and multiply them times typical 1 standard deviation and 2 standard deviation moves for that factor, so that you can then understand what the portfolio performance exposure is for both of those.
Yeah, correct. Yeah, I think so.
Because a one standard deviation move for momentum is greater than that of value. Interesting. Okay. Like I said, this is V1. It's good to, that's why you
Yeah,
put
thanks,
out a
Derek. Yeah, this is
minimum
great.
viable product, and then you get good feedback like this.
Want to open it up? Anyone else got any questions for us?
Can I jump in again? Sorry.
Of course.
John, just one question, and this is fairly basic. Maybe I missed it somewhere in your explanation. So the first column there, which says factor exposure beta, that's the Z-score of the individual security. And
It's the
what is
Z-score times your current exposure.
okay? And what is the optimal exposure again?
It's the Z-score times your optimal exposure.
Oh, okay, yeah, got it.
Yep.
Sorry.
And then the difference between the two is obviously the third one. No, actually, thanks for I should have made that more explicit. So thanks for asking.
So that optimal position that you're multiplying the Z-score with, that's the fundamental based suggestion of what the optimal exposure should be. Is that right?
Yeah, the way to think of it, it's your fundamentally based optimal exposure, and then adjusted by the Z-score to show what that position exposure would be to the factor.
Okay, got it.
At that optimal position size.
So the portfolio, across the portfolio, the different factor exposures are not meant to add up to one or whatever. Like, is there?
Correct,
like,
because
typically if you had more exposure to value, you'd have less to say growth, but it doesn't necessarily add up to a certain number, whatever that number might be.
no, because there's more. I mean, there's more style factors out there too. We picked and we've picked some of the more common ones that we think explain a good amount of returns and exposure. But there's also the kind of unexplainable piece, or the alpha. So the kind of they don't necessarily add up to one.
Yeah, you can think of it this way. If you were to add up your industry exposures, they would all add up to one. And but in this case, you could think of them as your beta. Just if you have all of your nominal exposure, it's going to add up to 100%. But if you multiply it times its beta, you could have a beta that's much larger than one or much less than one, depending on its beta. Well, that's the Z-score factor.
Yeah.
Depending on if you have very high or very low Z-scores, it's going to have a big impact on what that total exposure is.
Yeah, because on the Z-scores, I'm looking at our life portfolio here. As compared to the numbers you're getting there, the exposure to any single factor is fairly, I'd call it subdued. Like, it's six points. I don't know if that's how I should read it. 6-point Z-score for growth, and 0.06 exposure to Z-score for value. So it's just telling me the portfolio is neither too tilted towards growth, nor is it too tilted towards value.
Yeah, it's kind of like, are you?
That's right.
Yeah, and are you?
Could you say those numbers one more time?
So to growth, it's 6.07, and to value, it's 0.06. So value, there's almost no exposure, I guess.
Right.
Or maybe they're just canceling each other out. No,
not the growth and the value. They don't cancel each other out. They
no, I mean within value. Like
within
exactly.
value. That's
Yeah,
what's happening.
exactly.
That's what's happening. Inside of value, they're canceling each other out.
Yep. So you're essentially value neutral, based on how you're currently invested.
So can you go back to the slide that shows value? So you can imagine that you take all of your securities, let's just say that you have 20, and all 20 of them will end up having a score associated with them for value based on each of these individual inputs. There's going to be let's just say that there's 3,000 securities that go into calculating this. They're going to come up with a mean score. That mean score, let's just say it's 80. And that means that the average of the scores for the positions in your portfolio weighted by their position size is also pretty close to 80.
So what Z-score should I see in summation that would tell me that my exposure to this particular factor is relatively high or low? Like if 6 doesn't mean anything, is it over 20 that means that my exposure to growth factor is high?
Not if you're a growth fund. It's relative.
Yeah, I think it really depends on whatever your kind of strategy is and what you're comfortable with.
But how should I read a score of 6 for factor exposure to growth? That's very low. Is that how I should read it?
You would think about it the same way that you would think about beta or industry exposure. You know, if industry exposure were to be something that would matter, and let's say that financials is 20% of the market and you were 26, which is 6% different than the market, you know, you may say, okay, that's close enough. If you're 40, which is 20% different, you may say, hey, that's a big difference. So I don't know that John and I are going to be able to give you a recipe for what is the right way to know what is too much and not, or in bounds. I think that's something that will have to come to you, and we'll be glad to be helpful there. But I'd hate to give a prescription here that is generalized across everyone.
But if I think it in terms of standard deviation, a 6 summation of the portfolio means how many standard deviation from the average?
John, can you go to the Z-score, which would tell you the average Z-score of your positions? Let's do not beta. Are you going to do them all?
I was just going to pull them all in.
Okay, cool.
But,
yeah, that's fine.
So here's your total standard deviations away.
Yep. There's your standard deviations away.
So in this case, and it checks out with my adjusted exposure to growth is very low. It's almost more neutral, and you can see that it's 0.01 standard deviations from the mean.
And I think what ends up happening here is, as fundamental managers, there may be exposures that you didn't know were there. This is a way of trying to help ferret some of those things out. And if you see down here that there is something, which looking at these, there doesn't seem to be, but there may be something different. This is a dummy portfolio. There may be something different in yours. And if that's the case, then the next step would be to say to yourself, is that something that I want to control for? And so John was walking through the ways that we can control for some of those factors by adjusting the position size.
Okay, got it. Thank you.
Yeah, of course. Anything else, gang? Well, thank you, and thanks for bearing with us at the start of this. We will follow up with the PowerPoint, and just something to keep in mind. You know, these views are just kind of standard, kind of simple views that we just created so that you would be able to see all this stuff in one place. If you want, these columns are available to be added to your current views, or if you want to discuss different ways to kind of incorporate this into your process, please don't hesitate to reach out. That's what we're here for. And also with, you know, please take a look and give us feedback on how you want this to continue to evolve in the future. You know, Katie will be in touch after this call, probably later this week or early next week, to kind of try to continue gathering that feedback. But we, you know, Alpha Theory is for you all, so we want to make sure that the tools and functionality and features we're building are aligned with what are actually going to solve your you know, pain points. So please keep that in mind. And yeah, thanks again for
Let me
attending.
so Niraj had a good question about our relationship with Omega Point and how this relates to that. Is I think that you guys got the sense that actually, let me start by saying, for those that don't know, Omega Point is a risk tool where we have a tight relationship with them to help managers that want to manage their risk. So the question is, hey, is this just a replacement for what you're doing at Omega Point? I would say no. This is the, I'm guessing you could sense through this. This is the kind of risk 101. This is the tool that helps you understand some of your exposures and make decisions that can influence how you are managing risk in your portfolio. If you want to ask a lot of the questions you're able to ask, which is, how stable is this factor over time? Those are the kinds of things you can get from Omega Point. What has been our performance over time? I want to adjust a period. What if I exclude this position? All of those things are things you can do in Omega Point. You can also use other models. You can use the Axioma or Bara models and use them all together collaboratively in one system. So it does not replace I don't know that you necessarily, what would end up happening is, if you were to use the Omega Point version, we may replace the Factset model in here with whatever model you're using inside of Omega Point. So you'd still see these things, but you'd also be able to visualize them and ask a lot of other risk questions, risk specific questions in Omega Point.
That's right. Yeah, if you were using a tool like Omega Point, we would integrate with that. We already have a pretty robust integration with them, so it's kind of like flipping a switch, and you would be seeing that data instead of this data. Great question, Niraj. Thanks. Well, it is a little beyond one. I'm happy to stay on if folks have other questions, but otherwise, thank you again. And yeah, feel free to, like I said, please don't hesitate to reach out with feedback, more questions, anything really that we can help you with on this.
Great. Thanks all.
Thanks, everyone.